Provident Healthcare Partners is a healthcare investment bank that is focused on transaction advisory services. We created this podcast for healthcare executives, entrepreneurs, shareholders, and providers who are interested in learning more about the world of healthcare consolidation.
Hi, everyone, and welcome to the Provident Healthcare Dealcast. My name is Eric Major. I'm a managing director with Provident Healthcare Partners. I'm also joined today by Scott Davis, who's a director, and Kevin McDermott, who's an associate. The topic that we're going to discuss today is a recap on 2021 M&A activity within the healthcare sector, as well as an outlook regarding 2022 and some of the key takeaways that we had from the virtual meetings stemming from the JP Morgan Healthcare Conference back in January. Well, recapping 2021 healthcare services activity on a high level, across the private equity continuum, there were more than 3,000 transactions for the year. And specifically within healthcare services, approximately 115 new platform investments and over 600 add-on deals across many verticals within healthcare services. Certainly a significant rebound relative to activity in 2020. Starting with Scott, maybe some input from your perspective on what were the key drivers for activity in 2021 and what were some of the more active sectors that we saw within healthcare services?
Yeah, absolutely. I'd say first and foremost, it's just the amount of equity that's been raised and sitting on the sidelines. That's capital that has to be put to use at some point. And it feels like for the past 2-3 years anyways, with every month or quarter that goes by, a new record's being set for the amount of dry powder raised. So depending on the source you're looking at right now, I think they estimate that amount to be somewhere between $1.5 and $2 trillion. So that's capital that needs to be deployed in the eyes of investors and fueling a lot of the interest these days. The other component of funding these transactions from an LBO model, of course, is the debt. So similarly there, the amount of private debt funds that have been raised is continuing to increase. The access to that capital and the relative cost has remained consistent. And so that's fueled a lot of the transaction activity as well. As we think about the world that we operate in, the healthcare services environment, it's only proven to be more and more a defensible asset class when compared to other areas of the economy. And I think, oddly enough, all of the activity COVID related and just generally healthcare related the past couple of years has only allowed for additional investors to kind of pile into the space. So it's been a very defensible sector to be active in and has fueled a lot of activity from an M&A perspective. The year of 2020 in particular, initially dealing with the throes of the COVID impact, led to a decrease in deal flow for a short period of time. And what that was a lot of people kind of sitting on the sidelines, both seller and buyer for that matter. And I think it feels like we're making up for lost time there. The pent-up demand related to people not going to market, particularly on the buyer side, looking to deploy that capital, has led to a lot of activity in 2021. And I think we're seeing more of the same here in the early days of 2022. The other item that drove a lot of potential sellers to the market last year was the potential increase to capital gains tax rates. So there was, by the incoming president, discussions of nearly doubling what that rate could be, which would in a lot of ways negate some of the benefit of doing a deal. I think the sightline on that is considerably less than doubling. We'll see how that plays out, but it did push a number of prospective sellers to market maybe a little bit quicker than it would have otherwise, or got them thinking about the concept of transacting, whereas they wouldn't in the past. So I'd say those are all key drivers just from a macro perspective, and that we continue to see those play out today.
Yeah, in addition to some of those macro drivers, I think there were a lot of different themes that played a role in deal activity in 2021 and going forward. COVID really acted as this catalyst for private equity firms and other strategic companies to realign some of their values and some of their efforts. So, for example, one major theme we saw was the digitalization of the patient experience. So things included that what might be digital analytics technology, smart healthcare devices, other healthcare practice management software solutions, and other consumer-centric delivery models. And we can kind of lump into that ePro, which is electronic patient-reported outcomes, as well as eClinical, which might include things like web-hosted services, licensed enterprises, or other cloud-based systems as well to further reach patients and better improve patient outcomes. Another theme we saw as well, and this really acted, again, as a catalyst for a lot of, I think, private equity companies out there, is portfolio optimization. So a lot of firms sought to direct capital to innovations in patient treatment and to really reinforce their pharmaceutical pipeline with a particular interest in acquiring companies that specialize in things like mRNA or cell and gene therapies and other digital analytic capabilities, which I touched on briefly before. So this would mean things like, potentially increasing divestment of consumer-focused businesses like over-the-counter products, and then focus to specialty pharma developers like CDMOs and CROs, which have a very, very strong, robust, and specific pipeline targeted at finding new capabilities within the broader pharmaceutical drug development space. There's a certain advantage to having a kind of first mover advantage here within the pipeline and being able to get to market and get a drug approved by the FDA, which has tremendous tailwinds to a company and its pharmaceutical pipeline.
Transitioning from some of the growth drivers of M&A activity in 2021, what were some of the challenges that sellers and buyers faced? How did COVID impact that deal activity? Maybe Scott, we'll start with you.
Yeah, absolutely. So I guess thinking about this from both sides of the table, focusing first on the seller side, some of the challenge we saw was just the amount of deal flow that was out there. So as I mentioned before, there was a little pent up demand from a seller perspective as well as buyer, but from the seller perspective coming out of 2020. So that led to a lot more transactions being on market. So it was seemingly, more opportunities for the investors to focus on. So, I think in a normal time, there would have been less similar sized or focused businesses on market at the same time, which makes for a more competitive process. Luckily, we didn't see that really parlay into lower valuations, but we did see just the sheer volume of like-minded sellers on the market at the same time. So that was one component we dealt with. The overall amount of deal flow definitely put the strain on the advisor community that works within the M&A environment. I think from our perspective on the banker side, we didn't hear or personally see much of an impact there. We were very active, of course, but able to handle our deal flow as we selectively choose clients. But other areas that we saw pretty routine issues were around, quality of earnings or legal work. These are groups that are brought in on a case-by-case basis for different points of the transaction, and just getting into their pipeline of activity proved to be difficult. They're really a necessity as it relates to getting a deal done, at least getting a deal done effectively. And so just ensuring that we had those resources available did lead to a little conversation around how to plan out our marketing processes and the due diligence process for sure. So that was a complication that we worked through, but certainly had to deal with. And I think that also extends to rep and warranty insurance providers. At a certain point, we didn't see in our deal flow, but heard of, really the lack of options towards the end of last year in terms of those underwriters being able to take on additional policies. And so that's becoming more and more a common piece of these transactions, working its way kind of towards the lower middle market and really eliminate the need for an indemnity escrow. So it's great from a seller perspective, and it really gives the buyers the protections they look for on a post-close basis as well. So we saw that be a bottleneck for sure. From the buyer perspective, valuations continue to remain very strong. If anything, they probably creeped up a bit. To get into the healthcare sector, to the extent they weren't already, they were really having to shift their mindset for valuation. And those already in the market certainly have been paying up in prior years and continue to do so, if not go a little bit healthier on the valuations. Strategic acquirers, I think we got even more aggressive. Case study from our example at Provident, we did a number of eye care transactions last year. And while we thought a lot of those assets were platform worthy, they ultimately ended up transacting with strategic partners to be very meaningful regional or large add-on acquisitions for those groups, and primarily fueled by the fact that valuations were so strong from those strategic buyers. We've seen that in a number of different industries, most notably because they can recognize the cost synergies that come with those deals. And then lastly, I would say we saw this a good amount as well, just the prioritization of deal flow. So with the amount of deals coming into the buyer's specter, they really had to pick and choose their spots wisely. So in certain times, it was several deals in front of them in the same subsector. We unfortunately would love to pursue them all, but have to focus our efforts wisely. So we saw that be a complication, albeit probably a good issue to have to deal with. On the COVID front, we didn't see an impact in 21 from like a headline deal closure perspective. It was, as noted before, very robust year. So not so much there. I think where we saw the impacts were businesses certainly in early 21 that were transacting and still utilizing financials from at least a period of 2020, having to work through those consistent kind of COVID pro forma adjustments that have become pretty darn common in our world. So it affected things from that perspective, but not an issue getting credit for those. I'd say the second wave that we experienced towards the end of last year, the Omicron wave, we were better equipped, I think, as an industry buyer, seller, advisor, to really deal with those. And again, work through those adjustments that were needed to the extent they were, and really getting credit for those and moving pretty seamlessly. So I'd say the impact from that perspective was pretty mitigated. And the other side of the spectrum, in terms of an upward movement as it related to COVID, areas like urgent care, certain lab industries, certainly healthcare staffing, we saw a lot of these businesses actually do better than ever through 2020 or 2021 COVID environment. And so that's been something where we've seen an uptick in activity from the positive perspective. Looked at it in a different light in terms of normalizing for performance, a normal environment, but worth noting in that was an upside in terms of production.
Thanks, Scott. Great summary of some of the 2021 healthcare M&A activity drivers. Now, transitioning to 2022, starting with Kevin, would love to hear your thoughts and maybe some of the perspectives we heard from investors at the JP Morgan Healthcare Conference on what the outlook is for 2022 deal activity.
Yeah, I'd say in general, both sellers and buyers remain extremely bullish within the healthcare services M&A sector more broadly. I don't think we will see deal activity quite break the record of the volumes of deals in 2021, but we will still see probably elevated levels of deal volume activity compared to other historical periods. And I think that can be attributed to a few things. As Scott noted earlier on, deal activity essentially came to a halt for a period in 2022 at the onset of the pandemic. And I think through the end of 2020 and then throughout 2021, we saw some of that pent up demand and a lot of deal activity hit the market. And then in addition to that, there were a lot of fears of an increased long-term capital gains hike, which had a lot of sellers who might not have considered a transaction previously to explore a potential transaction in 2021. And a lot of those did actually transact. As we saw, there were 115 plus new platforms created and over 600 add-on investments in healthcare services industry. So we expect some of that momentum to carry into 2022, especially as those fears of a long-term capital gains hike have subsided. Areas that we expect transaction volume to continue to rise in 2022 will be mostly all the subspecialties within physician services, especially those that might have multiple ancillary services, including ambulatory surgery. They might have substantial growth potential, experience value-based care programs and have experienced management teams as well, which we can know makes a world of a difference when your physicians are not focusing on other back office or administrative tasks, but you have a dedicated team in place to do that. And then the physicians and mid-level providers can focus on providing care for patients. But there are some threats to what could be a very strong year of deal activity. Some of those things might include supply chain problems, which will continue to worsen. Inflation continues to grow and shows no signs of slowing. Ongoing geopolitical tension throughout the world, particularly at this moment in Eastern Europe. And then the threat to more interest rate increases, which are going to be implemented faster and or in larger increments than we previously have expected, which we will get into. In summary, I think all of these things together, we will continue to see strong M&A activity in 2022. But for those things that I did just mention, could see investor sentiment continue to decline in months ahead, which might discourage them from investing in new platforms or pursuing other transformative add-ons.
Yeah, thanks, Kevin. Those are some great themes for 2022. And specifically, diving a little bit further into some of the sectors that we expect to remain active this year. Scott, maybe touching more on the provider services sectors, which ones stand out to you in the investor community for 2022?
Yeah, I would say from a provider-based model, we'd expect really things across the spectrum to remain quite active. I think about kind of the bookends of that, the ones that have been consolidating for quite a while versus the ones that maybe are a bit newer. I could comment on those. I think everything in between will remain quite active. So for those that are a little bit, longer consolidating at this point, call it the last 6+ years, an area like ophthalmology or dermatology, we would expect to see some consolidation of the consolidators at this point, with continued kind of add-on activity and maybe even select platform opportunities still to pop up here. But, just looking, I think even the past 12 months or so on the derm side, we've seen groups like West Dermatology, Pinnacle Dermatology, Epiphany Dermatology, all transact from their prior private equity backers to new ones, kind of moving up in fund size that, will certainly have a heavy kind of M&A component and focus on them post-close. So I'd expect to see continued consolidation of PE-backed groups as a result of that, but then also some of the smaller add-on activity. The other end of the spectrum in terms of consolidation on the newer front, an area of focus that we particularly have at Provident and seeing activity elsewhere, cardiology. So that's an area where we saw several groups such as Varsity Healthcare Partners, Silversmith Partners, and Webster Equity all developed platforms of their own the last kind of 6 to 12 months. So we'll expect to see continued activity on that front. Highly consolidated, really hasn't had much activity to this point from a kind of private investment standpoint. Elsewhere, oral surgery, which technically has started consolidate a number of years ago, but really is picking up steam again the last kind of 12 to 24 months. We'd expect to see continued add-on activity there, and then have word that there's several other platforms still yet to come, probably in the near-term future. And I think the exit that Riverglade Capital had of U.S. oral surgery management only really added credence to that model. They were the group that initially kind of recapitalized an oral surgery specific group back in, I believe it was 2017. They've since transacted again just the past several months here. And, the outcome from that, I think, has made a lot of people that much more bullish on the space. So things like that are really driving, I think, some of the new investor interest here. And I'll turn it over to Kevin for some of the non-PPM focused.
Yeah, thanks, Scott. In addition to some of those PPM sectors, we also are keeping an eye on a few other additional sectors that we expect to remain very active. The COVID-19 pandemic has increased the demand for both mental health and substance abuse treatment health services. And the resulting interplay is really an imbalance of supply and demand for these types of services. So the low supply, high demand for these services has really created a really fierce competition amongst investors, leading to larger and larger valuations. So for example, last year we might have seen relatively smaller behavioral health or autism deals that might be considered add-on acquisitions for many of these existing consolidators and platforms. But because competition was so fierce, we saw a lot of private equity firms actually swim downstream and are willing to start with smaller assets to create a platform in the space in order to get their foot in the door, which is a pretty interesting observation. In addition to behavioral health, we also saw that investors really gravitated towards pharma services, which I noted a little earlier on in the podcast. And these are businesses I would characterize that have typically high margins, are positive cash flow, and have relatively low capital expenditure requirements. Specifically, clinical research sites in SMOs, CDMOs, CROs, eClinical, so things like on-demand web services, licensed enterprises, and cloud-based SaaS solutions. Other areas of interest too within the broader pharma services space include ePro, electronic patient reported outcomes, tech-enabled services, drug development, regulatory and consulting businesses, contracting, post-drug approval, marketing, and really any other business that has a regulatory burden backdrop to it. And then lastly, in addition to pharma services and behavioral health, another theme that we're monitoring closely includes telehealth, health tech, and data and analytics companies that enable quicker and more efficient and or virtual delivery of patient care via automation and digital solutions such as clinical decision support, which really create opportunities for investors and are really attracting investor interest as the world really shifted to a virtual setting at the onset of the pandemic. A lot of providers had switched to a telehealth model to further reach their patients in a more efficient and safer setting.
Thanks, Kevin. In summary, I think some of the key themes from the JP Morgan Healthcare Conference, and we touched on throughout the podcast today, I think general consensus is that 2021 was obviously a heightened transaction year for most folks, and that momentum is expected to continue into 2022. I think PE investors still remain very bullish on the healthcare services market and continue to be actively looking to put dollars to work, especially given interest rates, at least at this point, are still lower compared to historical norms. Scott, any other key takeaways that you think we should hit on as it relates to our conversations with the 40 or so odd investors that we spoke with?
Yeah, I would just add that definitely aggressive and bullish kind of outlook for this coming year. One thing I know that many groups expressed was a little level of frustration they didn't get as many platform deals done in 2021. So maybe a higher degree of add-on activity, but really where they're going to be able to put equity to work in a more meaningful way is through initial platforms, of course. And so I know that's an area of focus for a lot of groups, particularly on the physician practice side. So we mentioned a few earlier, but in addition to those areas like orthopedics, we're already seeing a number of platforms be formed there towards the end of last year or early 22. Gastroenterology, pain management is another area of focus kind of in its second iteration of consolidation, and neurology as well, where we remain very active on the Provident side. So I'd say there's going to be an increased emphasis on platforms and ideally probably in some of those newer to consolidate areas that I just mentioned. And then, the kind of stalwarts of the industry that I mentioned before, eye care, dermatology, the like, I think we're going to continue to see deal flow, maybe even tick up. You've got the consolidation of the consolidators I mentioned, seeing that play out in dermatology. I think ophthalmology should follow suit pretty quickly. And then along with that, you've got existing platforms that are very aggressively pursuing add-on activity, but also for these ones that have just changed hands between private equity investors, the need to deploy capital is all the greater. So we'll see some, again, I think fierce competition and potentially even acquisition of larger assets that may have backing already take place.
Yeah, thanks, Scott. That's a great summary of some of the key themes for 2022 and spaces that we expect the market to be active in. And thank you both for joining the podcast today. And thank you to our listeners for joining as well. Feel free to visit our website at www.providenthp.com for more information around these topics and others as well.